Right now, as you're watching this video, silver is trading at $87.50 per ounce on the spot market. Just 3 days ago, it hit $91. As of today, February 26, 2026, silver has already surged 23% since January 1st, and that's after one of the most violent crashes in modern market history. But here's what's keeping experienced traders up at night. When silver collapsed 35% in a single day on January 31st, one institution allegedly closed a $10 billion short position at the absolute lowest price of that crash. Not the day before, not the week after, at the exact bottom. That institution was JPMorgan. And if what the data suggests is true, it may be the single most consequential trade, or the single most devastating market manipulation, in the entire history of the silver market. Stick with me, because by the end of this video, you are going to understand exactly what happened, exactly where silver stands right now on February 26th, and exactly where the smart money thinks it's heading next. Let's get into it. To understand today's market, you have to understand the last 15 years of silver's story, because none of what's happening right now makes sense without that context. JPMorgan didn't just participate in the silver market. For over a decade, they dominated it. When markets hit record highs in late January 2026, the CME increased the margin requirement on silver from 11% to 15%, forcing highly leveraged speculators to either pour massive amounts of capital into the system or close out their positions instantly, turning a market correction into a crash. But long before that moment, JPMorgan had already been found guilty of playing a very different kind of game. They were caught spoofing, placing massive fake orders to move prices, then canceling them before execution, tens of thousands of times. And in 2020, they paid $920 million in fines to settle those charges. Nearly $1 billion. Not accused, not alleged, admitted and settled. That is the institution we are talking about. That is the history we are dealing with. And knowing that history is what makes the January 31st trade so extraordinary. Here's the timeline that matters. In mid-2025, something unprecedented happened. Silver surged 147% through 2025, climbing from around $28 all the way into triple digits by late January 2026. And running alongside that climb, according to multiple metals analysts and market observers, was a quiet but massive structural shift in JPMorgan's positioning. They began unwinding their short book. They began flipping long. And by the time silver was approaching $120, JPMorgan wasn't fighting the rally anymore. They had become the rally. Then came January 31st. As the market hit its record highs, the CME aggressively hiked margin requirements, from 11% to 15% for silver, which forced a wave of leveraged position liquidations that turned a routine pullback into an absolute avalanche. Silver went from $121 to $78 in hours, the worst single-day crash since 1980. And right there, at $78, the exact intraday floor, JPMorgan reportedly closed the remainder of its short book. $10 billion in short contracts, bought back at the lowest price of the crash. If you're short, you profit when prices fall. You lock in that profit by buying at the bottom. So closing a $10 billion short at $78 means they pocketed the entire spread between wherever they entered and $78, while simultaneously, the act of buying that many contracts at the bottom created a floor that prevented further collapse. The bears got destroyed, the retail longs got liquidated, and JPMorgan walked away with generational gains. Coincidence? The data doesn't make it easy to say yes. Now let's be precise about what we know and what we don't, because integrity in analysis matters. There is currently no confirmed enforcement action, no indictment, and no regulatory finding that declares this specific trade illegal. What exists are data points, an extraordinary pattern of timing that multiple seasoned market analysts have publicly described as almost impossible to explain as random. Whether that constitutes market manipulation in the legal sense is something regulators would need to prove. But in the court of market logic, the sequence of events, systems offline, margins hiked, shorts closed at the exact bottom, is something you can judge for yourself. What is not in dispute at all is what silver's market looks like today, right now, on February 26, 2026. And this is where the story gets genuinely compelling for investors. As of this morning, silver spot is trading at $87.50 to $91.40 per ounce, extending what JM Bullion describes as a powerful February rally, fueled by safe haven demand tied to U.S. tariff uncertainty and Middle East tensions on top of already tight physical market conditions. Silver is consolidating between $89.70 and $90 today, after a strong 4% jump earlier this week that pushed it to a 3-week high of $91. And year-to-date, even after the January crash, silver prices have increased 23.09% since the beginning of the year. Let that sink in. We're not even 3 months into 2026, and silver is already up nearly a quarter. The gold-to-silver ratio tells an important sub-story here. The ratio stood at 59.20 today, up slightly from 58.29 on Wednesday, which means silver has been dramatically outperforming gold over recent weeks. Historically, when the ratio compresses below 60, it signals that we are in the aggressive, later-stage phase of a precious metals bull market where silver leads. That is exactly where we are right now. And when silver leads, it tends to lead hard. The technical picture today is clean and bullish. On the 2-hour chart, silver is pausing after testing $91, but continues to follow a rising parallel channel that started all the way back at the $73 level. Key resistance is at $91.27, with a potential upward move toward $95.23 if that level is broken. And beyond that, the psychological and historically massive $100 barrier. Fibonacci wave analysts at Wave Traders noted that silver surged 24% after their February Wave B call, rallying from key Fibonacci support with room toward the $92 to $94 resistance zone. Multiple independent technical frameworks are converging on the same price targets: $92, $95, $100. That kind of consensus across different methodologies is meaningful. But here's the thing about silver that separates it from almost every other market. The technicals and the fundamentals are telling the same story at the same time, which almost never happens. The Silver Institute's latest 2026 forecast confirms the market is facing a significant structural deficit for the 6th consecutive year. Global output is expected to reach a 10-year high of 1.05 billion ounces, but mine production is extremely difficult to increase because most silver comes as a byproduct of zinc and copper mining, meaning you can't just decide to produce more silver. You need more zinc and copper mines to come online first. That's a multi-year process. Meanwhile, demand is running hot from every direction simultaneously. AI data centers need silver for their high-conductivity contacts. Every electric vehicle on the road contains silver in its battery management system, its motor controllers, and every charging circuit. Every solar panel, and the world installed more solar capacity last year than in all previous years combined, contains approximately 20 grams of silver. The demand is structural, it's not speculative, it's not reversible. It is baked into the global energy and technology transition that every government on Earth is committed to. Despite a paper market collapse, silver is structurally in a deficit because of AI and solar demand. Industrial dip buying has been aggressive at every pullback, meaning the manufacturers and industrial consumers of silver are not waiting for lower prices. They are buying on every dip because they need the metal. That kind of physical floor under a market is not something that gets talked about enough in mainstream financial media, but it is one of the most important structural supports in the entire silver story right now. And then there are the geopolitical catalysts that are unique to this moment in February 2026. Investors are closely watching the third round of US-Iran nuclear talks in Geneva today. Ongoing threats of military action against Iranian nuclear sites are keeping silver prices supported, making major price drops unlikely in the near term. Because silver, like gold, responds to geopolitical fear as a safe haven. At the same time, Trump's tariff policies are creating a structural safe haven bid that is persistent, not just episodic. Silver fell slightly on February 26th as the dollar stabilized on weakness in the yen and better than expected U.S. consumer confidence data, which is your explanation for today's modest pullback from $91 to $87.50. But this is noise within a much larger signal. Let's talk about what happens next, because this is the question every single person watching this video wants answered. There are 3 realistic scenarios for silver from here. In the most bullish case, silver breaks through $91.27 resistance, tests $95, and then makes a legitimate run at $100. Algorithmic price forecasting models currently project silver reaching $107.40 by March 3rd, an 18.55% gain in the next 7 days, which is an aggressive call, but the momentum data supporting it is real. Some analysts project silver reaching $100 to $200 by early Q2 2026, linked to long-term fiat currency debasement and potential equity market weakness, rather than short-term events like tariffs. If the Fed cuts rates in the second half of the year as markets currently expect, if the dollar continues to weaken, and if the Iran situation escalates into a genuine military conflict, silver could move faster and higher than almost any mainstream analyst is currently projecting. In the base case scenario, silver consolidates between $85 and $92 for the next several weeks, digesting the extraordinary moves of the past month, before making a fresh attempt at $95 and then $100 in the spring. This is what the technical channel structure suggests. As long as rates are falling, the dollar remains under pressure, and geopolitical risks stay elevated, silver prices are likely to remain elevated and volatile, which is the base case macro environment as of today. In the bearish case, and you need to hear this because balanced analysis demands it, the CME could hike margins again if volatility spikes. The Kevin Warsh confirmation as Fed chair, with his well-known hawkish tilt, could strengthen the dollar and pressure metals. Expectations for further rate cuts have faded, with several major central banks signaling a pause or even a tilt back toward tighter policy, making it harder for precious metals to push significantly higher without fresh catalysts in the near term. A strong dollar, a risk-on equity rally, or another CME margin intervention could push silver back toward the $78 to $82 zone. It has happened once this year already. It could happen again. But here is the larger truth that transcends all three scenarios. Silver jumped from $28.92 to over $70 in 2025 due to record industrial demand, shrinking inventories, and a fifth consecutive global supply deficit. And the forces that drove that move, the sixth consecutive deficit, the AI and EV demand, the solar transition, the de-dollarization trend, the debt levels, none of those have gone away. They have gotten stronger. A 50-year cup and handle pattern on the long-term silver chart completed recently, described by some technical analysts as the most powerful bullish reversal in history. That is not a pattern that resolves in a few weeks. That is a pattern that takes years to fully play out. JPMorgan's alleged $10 billion short closure at the exact bottom of the worst silver crash in 44 years may never be proven as manipulation in a court of law. But it tells you something crucial regardless of the legal question. It tells you that the most sophisticated, best resourced, most deeply embedded institution in the silver market, the institution that knew this market better than anyone else alive, looked at $78 silver and decided to buy. They didn't hesitate. They didn't wait to see if prices would fall further. They bought everything they could get their hands on at that price. And now, sitting at $87 to $91, with $95 and $100 in sight, it's starting to look like they may have been the smartest people in the room once again. The question you need to answer for yourself is not whether JPMorgan manipulated the market. The question is, now that you know what they apparently know, are you going to be on the same side of this trade as they are? Watch $91.27 resistance today and tomorrow. A clean break above that level with volume opens the door to $95.23. And if silver closes a weekly candle above $95, the $100 target becomes not a question of if, but when. The silver story in 2026 is far from over. In many ways, February 26th may turn out to be one of the last calm days before the next major move. Stay positioned, stay informed, and don't let the noise of a single down day make you lose sight of a decade-long structural setup that JPMorgan themselves apparently couldn't afford to be on the wrong side of anymore. If this breakdown gave you real clarity on what's happening in silver today, hit that like button, subscribe for daily market updates, and tell me in the comments, do you think JPMorgan engineered the January crash to close their shorts at the bottom? Or was it just the luckiest trade in history? Drop your answer below. I read every single one.